Welcome to the Startup Dentist Podcast. I'm your host, Steven Trutter. After over 800 plus successful dental startups, I'm here to share everything I know about starting a profitable and purposeful dental practice with you.
Welcome back to the Startup Dentist Podcast. Super great to be here. If you're just tuning in for the first time and you say, boy, that's his voice. Yes, today, this is my voice. If you've heard me many, many times over, you've been following this podcast, you're probably going, Steven sounds a little different. Yeah, I got a little bit of Barry White going on right now. So I've got that annual cold, or for me, I think it's like every 2 years I get this cold. I sound worse than I feel, but it's like, it's there. So I got super deep podcast voiced here. So, hey, you're thinking about practice ownership. And here's the thing. And you're wondering like, okay, what's this going to do for my home life? Wife, husband, significant other. Check out one of my most recent episodes where I interviewed Dr. Dan Denowitz and his wife, Michelle. And we talked about like life, becoming a practice owner. How did that affect them with their children, the transition from associate, life, the balancing act, the honest conversations, the challenges, the sleepless nights, and all those different things. So check out that episode and really get a sense of like, what does it take? What is the pull that's going to have on my personal life of becoming a business owner? Because there is, especially in the beginning, and really make sure you can have those honest conversations with your significant other going into this journey of becoming a practice owner. Today, we are going to start talking about financing. You know, one of the first big things you got to talk about when it comes to whether you're buying a practice or starting up a practice is, do you have the necessary financing? I think there needs to be a better understanding. The environment constantly shifts. Banks require different elements that are today. Yes, they're still lending and depending on interest rates and everything, but all those things are important. But more importantly, what you need to understand is like, how do you best prepare for this? What to look for, what needs to be included in your budget, whether you're purchasing a practice or you're starting one up from scratch. So we're going to start to dig into this particular topic. So grab your notepad and let's make this dream practice of yours a living and breathing reality. All right, folks. So let's talk about what you need to do in order to prepare for financing. No money, no practice. That's how this works. So we need to make sure that you've got all these things that are in line, make sure that you're there. Whether you're starting a practice or whether you are acquiring a practice, there are some common elements that need to be done or there's some common check boxes that are going to be here. Let's talk about the preparation. Now, most banks, so if you're a D3 or D4 student thinking about practice ownership, most banks, I'm just going to tell you, they want some time. They want generally 9 to 12 months of you working outside of dental school in order for you to apply for financing. That's just pretty broad statement. If you're a specialist in residency, they look at that a little bit differently. So for those specialists that are listening here today, you are already licensed as a dentist. So that time as a licensed dentist counts towards that coming out of residency. Now, most banks are going to want you to complete your residency, obviously, before you apply for financing, or at least be able to access the funding. A lot of times when we're working with those that are still in residency, there's kind of that timeline that's there. So just kind of give me an idea like, okay, when can I start applying for financing? Let's talk about this. What do you need to look like from a financial perspective? Credit score. So we can talk about credit, liquidity. We're going to talk about debt to income. We'll talk about experience. So let's talk about credit score. Very simply, most banks are looking for that 700 plus FICO score. Some may dip in that 680 range, but generally speaking, 700 is kind of the going rate. Keep yourself there. Keep your credit card balances in check. We'll talk about some of those different elements that are there. Credit score, 700 FICO score. There you go. Liquidity, 5 to 10% of what you're going to borrow. Let's talk about what do you need to borrow. Startups are in today's environment are 700 to 900,000. So you need to have about 5%, 5 to 10% of that number. The same thing applies for your practice purchase. So you need to have 5 to 10%. Here's the thing when it comes to liquid assets, like the banks would much rather you have some debt and liquidity than none of each. Yes, I said that. Yes. Liquidity is equal, if not more important than the amount of student loan debt that you have. So don't sacrifice your ability of having liquid assets and having savings over focusing on like paying down your student loans really, really fast. Because if I took two doctors to the same bank and one had $150,000 in student loans and a payment of $4,000 or $5,000 a month because they refinanced, they wanted to tackle their debt, but had no liquidity. And then Dr. 2 came in and had $400,000 in student loans that was on IBR, but had $75,000 in liquidity, that second doctor with more student loan debt would probably have an easier path of getting funding. If the choice is, do I want to pay down student loans or do I want to pay myself liquid assets, especially if you want to become a practice owner in the next couple of years. If you have zero dream of becoming a practice owner, then you're probably not listening here. Then tackle your student loans. But if you're thinking about practice ownership, like pay yourself first. But also, I'm not a financial advisor, so don't treat this as financial advice. But just from a broad picture, you should have that rainy day fund just from a personal perspective. If something happens, you get injured or you can't work for a period of time, or you're saving up for a home or you're saving up for a marriage or whatever those things are, it's always good to have those liquid assets anyhow. So student loans, I get they're higher, they grow. The amount that you borrow today is far more than what you borrowed 20 years ago and 30 years ago. Totally understand that. But one thing that still banks are looking for is your ability to save and your ability to have what I like to say, the rainy day fund. So liquidity is a very important part. So venturing into practice ownership, make sure you have about 5 to 10% of what you're going to borrow. What does that mean? Okay, I'd say 35 to $75,000, maybe up to 100 in liquid assets. It's kind of on the upper range if you're borrowing for a bigger practice and things like that to purchase. If you're in IBR, I would, or any kind of like pay programs and those different elements, IBR is income-based repayment options, stay there because you're thinking about practice ownership. Stay there because don't force yourself into higher payment because banks are looking for cash flow is more important than the debt. The fact that you may have a lot of student loan debt, yes, it matters to banks, but what matters more is what do you need a service on a monthly basis? So what I would always say is keep the lowest possible payment on your student loans, tackle your student loan debt. Once you qualify for financing, once you become a practice owner, you get a couple years underneath your belt and then start to tackle those. You'll have a better idea of what your personal cash flow is as a practice owner at that point. I would say resist the refinance today because you're thinking about practice ownership. If that means your payment goes up dramatically. Banks are looking for what you need a service on a monthly basis, not so much how much you owe in student loans. Big difference. Monthly payment matters. Experience. Make sure you can, experience in terms of your experience as a dentist. Typically a year, I mentioned that. If you can gather production history and things like that, especially if you're buying a practice, that's always a really good path to go and what to look out for. When it comes to the different banks that are out there, I'm a big fan of dental specific lenders. Obviously, there's a lot of different players out there from Bank of America to Huntington to Live Oaks. There's Provide and different lenders are out there. And there's probably lots of other. And then you've got probably have your local lenders as well. I would always say you don't need 10 choices, 2 or 3 options, whether you're starting up a practice or acquiring a practice. Now, some banks don't have the same appetite for startups as they do for acquisitions. So certain banks may only do acquisitions, while others, your B of A's and your Huntingtons and Provides, they will play on both sides of that ownership path, whether it's startup or acquisition. You've got your local banks. I'm not a huge fan only because I've never found local banks to be quite understanding of what it actually takes to acquire a practice, or especially with a startup, they really don't understand. And in most cases, most local banks are what we would call more asset-based lenders. Most dental-specific lenders are looking at or more cash flow-based lenders. What's the difference? The difference between these two is this. A cash flow-based lender, these are your dental-specific lenders, especially when you get into startups. They're looking at the future business and they're leaning up against historical numbers. They've been doing it for 20 years or more in a lot of cases, or the background. They understand what it takes to open up a practice. So they're lending against their portfolio that says, okay, our portfolio performs at 99%. So maybe they say only 1% of our practice owners default on our loans. They're lending against that. And they're looking at the future cash flow of the business as opposed to what you currently have in terms of assets. That's where most local banks, your traditional bank, you sit down with your banker, you sit down at the branch and things like that. And the local bank person says, we really want to work with local businesses. We want to do this. And you say, great, cool. I need $750,000. I want to open my own practice down off Main Street. And the banker goes, cool. Yeah, we're really in the dental industry. And then all of a sudden they say, hey, so you need $750,000. Why does it cost so much? Red flag if they ask you that. And then number 2 is in order for us to lend this amount, we need to find something or people or things that can help offset what we're lending. In other words, what are the assets that can equal up to or close to the amount that you're going to borrow? I actually had this happen with a client a number of years ago. His name was Dr. Brian. Maybe some of you have heard the story before, but I'll tell it again because this gives you a glimpse. Dr. Brian wanted to work with a local bank, and I said, sure, we'll bring in here's a local bank. He really wanted to work with, somebody, a local person, just, from a commerce perspective, going to his community. And I said, all right, local bank, you got that option. Let's review that. Our team is going to bring in a few other of the bigger players that really understand this. After several weeks of going back and forth with the local bank came back and said, hey, guess what? We think we can approve this request. It's gone to the committee. All local banks have committees too, by the way. They came back and they said, we can lend this amount of money for you to start up your practice, but we want $200,000 down, and we want your in-laws, yes, your in-laws to co-sign the loan. I don't know about you, but I love my in-laws. That would be a tough conversation for me to go to them. In the fact that they needed like a couple $100,000 to do this, not a solution. Now, that's not to paint all local banks into this outlook, this corner of like, this is what they all do. But after 20 years of doing this, that's pretty common stuff. They are asset-based lenders. They want to know if they're going to lend X, what do you got? They're going to want your home and all these different elements that are there. Explore these different options. There is SBA products that are out there. So most of the big lenders also provide what's called SBA, which is a small business administration. This is a great product if you're buying commercial real estate. It's not a great product for a practice loan. Over the years, if there's challenges with some of the local, the bigger lenders and the dental specific lenders, your project, or maybe you had a couple of snafus on your credit report or something like that, over the years or something, and dental specific lenders didn't quite have the appetite. SBA is a really good product for that, but I wouldn't go SBA as a first option. It's more of a like, okay, if we work through all the other options, let's go down that path. But SBA is a really good product when it comes to commercial real estate, whether you're purchasing a condo or the building that you're going to buy the practice in, or you're doing a startup and things like that, or even ground up construction, if you're venturing down that path. So SBA, really good product. Just keep in mind, like as you go into SBA, since it's government guaranteed, a lot of times the loan is guaranteed from the government to the bank and things like that. Keep in mind, like there's a lot more paperwork to go through that. You'll need to go down those different elements with them. There's an SBA guarantee fee, so the fees are higher, but there's a path that's there. But again, for commercial real estate, especially when you're taking it out for 20 or 25 years, really good product that's there. What are you going to see from most dental specific lenders in terms of products for practice loans is typically 10 to 15 year financing with the right bank and those with the right appetite. Shouldn't have to put in a down payment. So when I was talking about that 5 to 10%, that is not something you have to inject into the loans. It's more of like they want to make sure you have the liquidity if something happens, if you're transitioning over from your associate position to full-time into your own practice and things like that. You're kind of bridging the gap from an income perspective. Those things are there. With a startup, most banks are going to have a ramp up period, or maybe some graduated payments, like an interest only period. So that's the other big thing. When you're looking at a startup, what I would be looking for in a lender is obviously, term and rate and things like that, but look at the conditions of the loan. What's required of you? What is the length of term? What kind of graduated payments? Because as a startup, you don't have cash flow from day one. So it's imperative that you have something that allows you to not have to pay during the construction of your startup, a construction period, and also gives you some lower payments for the first year or two, or something along those lines. Because we need to maximize cash flow of your practice. So some interest only period along with or graduated payments, and that need to be in there. What you didn't hear me talk about is interest rate. Okay, interest rates, where they are today could be different in 6 months than what they were 10 years ago. They're going to fluctuate. So while I think interest rate, yes, important, it's not the first thing I look at when it comes to the guidance that I've given to any clients over the years here, IDEAL practices. What I look for is, and what our team looks for, we have some really great team members that understand this business, is we're looking at what is the structure? What is the dollar figure? Because what you don't want to do is underfund your startup. What I'm not a proponent for when it comes to startup financing is like, you don't need to over borrow. What you need to make sure is that you borrow adequately to cover the project, working capital, adequate for marketing, supplies, payroll. Because here's the thing, folks, in a startup, you've got lots of line items when it comes to your budget. Underestimating these costs is going to underfund your startup. Now, I would focus on like the growth elements. Now, people have heard me talk about growth strategies versus saving strategies. I'll talk about it again until I'm blue in the face. Like, you're not going to save your way to prosperity, but there's ways to save within your project when it comes to a startup. Because here's the thing, there's a lot of area, does it mean equip all your rooms? Nope, you don't need to equip all your rooms from day one as a startup. Are there like different materials and things like that you can save on and find alternatives with your contractor and architect? Yes, because a lot of times, you get a designer in there and everything. It's like, whoa, there goes the budget. They're building it out for their portfolio versus for function. There's a lot of things you can find in chairs and units. Now, I wouldn't buy the cheapest chairs that are out there unless that just fits your vision and your ideal patient. But there's a lot of mid-range type of equipment that's out there that can help find savings as well. Make sure you have a marketing budget. How much does that need to be? It varies on the marketplace, but you need to look at like, how do you launch a practice? You need to make sure you have adequate for the startup with building out your website, have a social media campaign, have branding products with your logo and things like that to be able to do events, maybe in your community. A thing, you're going to have a kickoff party, an opening party within the first month or two after opening your doors. That's a marketing element. And then the actual, if you're doing any kind of Google ads or social media ads or I'll just say paid ads in general, you need to have all that built into your budget. You need to have your lease payment. You need to have your loan payment and everything even factored into your financing when it comes to a startup. That's how important this is. So are you going to borrow somewhere in that range of, $600,000-$700,000, maybe up to $900,000, depending on your marketplace? Yeah, you are. And again, a lot of times what's the driving force within some of the prices, is construction, because construction prices actually vary quite a bit across the country. The Pacific Northwest is traditionally some of the highest, and most expensive build outs within the marketplace, down kind of the West through California into the West Coast, whereas areas like Texas, more affordable in terms of construction, and in mid-Atlantic and some of those areas, it all varies too. So, but again, like construction, equipment, a chair typically in Florida is, same price of a chair in California, generally speaking, for the same model and things like that at the same time of the year. What the difference is going to be between a Florida and California or a Texas and Seattle is going to be construction costs, and what those elements are. Just like real estate costs are going to vary on a market by market basis as well. Look at those different lenders that are out there and make sure all those different elements are there. I talked about structure with an acquisition. Your typical, so with an acquisition, you've got the purchase price of the practice, and then you also have working capital. Pretty simple financing when it comes to acquisitions. Those structures typically are going to be on a straight payment, a 10-year, 12-year, or 15-year amortization. What usually doesn't have those step payments in it or the ramp up period that a startup would. Why? Because you have cash flow when you're buying a practice. So it's just going to be a little bit different that's there. Personal guarantees. Here's the thing, folks. You're going to be personally guaranteeing your loan. The reason why is, and people have asked like, oh, can I get around this? No, you are the collateral. Without you, there is no dental practice. It's a little bit different with other businesses that are out there. Large corporations, a CEO could leave and it doesn't really matter. But when you, who is the CEO of your dental practice, leave, without a dentist, that's not a dental practice. So you're going to be personally guaranteeing your loan for the entirety of the practice, but doesn't mean you're securing it with your assets. Now, the one thing you want to make sure also with the banks is that just because you're personally guaranteeing doesn't mean that it's showing up on your personal credit bureau. Banks typically don't report these loans because the borrower is your practice, or if you're buying real estate, you have a real estate entity and things like that. The borrower is your entity. You are the personal guarantor for the loan. You are the biggest collateral, your dental degree, and all those different things. So the same thing is going to hold true when it comes to your lease. We'll talk more about like what to expect in terms of real estate and all those things. But most leases are going to have some level of personal guarantee. Sometimes with leases, we can peel those off over a period of time. But with a bank, your personal guarantee will be for the entirety of the loan period. So if it's a 10-year loan or 12-year loan or 15 loan or whenever you decide to pay off that loan, you will have a personal guarantee that's there. Now, the big thing is getting prepared. The thing that we call it here is we like to call it the silver platter method here at Ideal Practices. And what we do with our clients is we put together a business plan. We make sure we tell a story to the bank. Now, not all banks are going to require a business plan, but you should have one because you're building a business. Let's have a plan. Now, it's not a business guarantee because there's projections and all those different things that go in there. So what do you need to have in a business plan if you're going to approach banks that require this? And either way, if you're going to build a business, you should have a business plan. You want to make sure that you have an executive summary that tells the story of who you are, why you're qualified to do this, your background, your production capabilities, your vision, all those different elements you need to go into this executive summary. This is your brag moment to be able to talk through this. You need to have a summary of your demographics. Okay, so what's going into, what's the opportunity, especially for startups, like what is that opportunity that exists there? And even with an acquisition, it's like, having a background of like, what's the marketplace, what's the market opportunity of acquiring the practice, but especially for startups, have the information there that's there. Your marketing plan, how you're going to get patients, whether you're buying a practice or you're starting a practice, you want to make sure that you have a marketing strategy. We like to include a 3-prong approach with like having an agency, having ground marketing, and have some sort of purposeful philanthropic element that's there. But what is your overall marketing strategy from day one? How are you going to get patients through the door? Obviously, website, paid ads. Are you going to do ground marketing? What kind of ground marketing? Events, direct mail? Maybe that's a part of your strategy. You need to be able to tell yourself and a bank, well, how am I going to get patients through the door? And so fourthly, now we need to talk about budget, and then we need to talk about projections. So your budget, provide a general budget of what that project is going to look like. And then also like, what are your projections for the practice as well? Like, what does that look like for the first 2 or 3 years? Accountants can put this stuff together as well for you. But again, they're projections. We gather projections from over the years from what our clients have done. We gather projections from historical numbers, our collaboration with banks to be able to put our projections together. But again, there's a lot of things you can change with those projections, what you invest in different areas. But those are the basics of what you want to have in your business plan to approach the bank. The other thing is like understand your finances. Don't go into the bank going, man, I'm going to pray that I'm in good shape. Have that 5 to 10% in liquid assets. Making sure that you have probably less than $20,000 in credit card debt. I think it's a good thing to have. And just making sure that your repayment structure for your student loans aligns with your plans for practice ownership. In other words, if you're in any kind of IBR type of repayment structure, stay there. Have the lowest possible payment. One of the big questions I get a lot of times, whether it's at our course at Startup Practice Blueprint, I'm going to become a practice owner. Should I buy my house first or should I do my practice first? I'm not a mortgage expert, but I can tell you that most mortgages require, some sort of like 2 years of income and things like that. So if you're going to become a new practice owner, acquiring a practice or starting up a practice, you obviously got to wait a couple of years before you can prove what that income is that's there. I'm a big fan of practice first. Here's why. Your practice may give you a lot of influence of where you want to live. Maybe you want to have a little bit of a buffer zone. Maybe you want to not live right next door to your practice or in the same town. Maybe you want to live in the next town over. What your practice does into trajectory may actually have some influence on how much you want to spend. What you spend today on a house might be a lot less than what you may spend in a few years. You may say, you want to hold off on that for that bigger home. Maybe you have a family event of like having children and things like that. And you might be at that time of your life where like practice ownership, families coming down the road. I would say then practice first so that you can have that path and give you more clarity on what it looks like in terms of, what you want to do with your home. Hopefully that gives you some insight that's there. All right. We have covered a lot of ground here on the financing. So here's the thing. I'll leave you with this. There's different options that are out there. Number one, get prepared. Number two, explore different options. Number three, understand your finances. And before you apply for financing, really give a background check and making sure like you've got everything in line that is there. Make sure you're properly funded. Don't be underfunded. Don't go in thinking like, I only want to borrow $500,000 for a startup that's going to realistically cost you $800,000 to $900,000. Because if you're going to skimp in areas, you'll end up skimping areas like marketing and areas that actually can help you grow your practice. This is what the environment is today, what you need to borrow. I didn't talk about prices in terms of acquisitions today because you just never know where that practice price is going to land. But startups, a little bit more defined of a range of where that's going to be. I hope this helps. If you want to learn more about not only financing, but this entire process, then join us April 25th. It's a Saturday. Our Startup Practice Blueprint course, full day immersive course, where you're going through not only financing, demographics, we're going to talk about floor plan strategies, equipment construction, systems, protocols, your marketing strategy. We're going to talk about real estate strategies, all of the steps of this process. You can join us there. You can go to startuppracticeblueprint.com to register. Seats are going to be limited. It's going to be virtual. So we're going to be here. And in the past, we have filled this up very quickly. So you want to learn more about all aspects, go to startuppracticeblueprint.com and register for our upcoming event here in April. On our next episode, we're going to talk about reclaiming the patient relationship in a world that's kind of speed obsessed. Maybe you're working at a DSO, maybe you're working corporate dentistry. And I know some of our clients are thinking about I want to become a practice owner. I want to have a practice the way that I want. I want to treat the patients the way that I want. I don't want this to feel like a transaction. We're going to talk about that. So that's a wrap on the topic today of the financing world. Don't forget to check any show notes for any links and resources we talked about today. We will be talking about really developing that patient-centric relationship, how you can focus on that, and how by building one at a time and just having those connections can build you a highly successful and profitable practice. I'll see you there. Take care.
As we wrap up this episode, take a moment to picture yourself a year from now. Are you still in your associateship, or are you rocking it at your own dental practice, creating beautiful smiles and making a real difference? If that's the dream, it's time to chase it. Before we split, make sure to hit subscribe, drop a review, and give us your rating. It helps us keep bringing you the good stuff that you're into. Until we meet again, keep taking that next step towards your future practice. Here's to investing in your dreams and making them a reality.